Welcome to the Contrarian Investor Podcast. We give voice to those who challenge a prevailing sentiment in global financial markets. This podcast is for informational purposes only. Nothing on this podcast should be taken as investment advice. Guests were not compensated for their appearance, nor do they supply payment in order to appear. Individuals on this podcast may hold positions in the securities that are discussed. Listeners are urged to educate themselves and make their own decisions. This podcast episode may have ads and the occasional announcement. To listen without ads or announcements and take advantage of a host of other benefits, consider becoming a premium subscriber. Visit the website contrarian.supercast.tech. That's TECH for more information. Now, here's your host, Mr. Nathaniel E. Baker.
Leo Schmidt, CIO of River Eddy Capital Management. Welcome back to the Contrarian Investor Podcast.
Thank you, Nathaniel. I think this is my third time here, so it's been a lot of fun.
Yes, third time. It's been a while. I believe we have to go back to 2022 or so since you were on. I've been meaning to do this, haven't been, but I'm thrilled to have you back. We are recording this on Friday. What day is today? June 7th, Jobs Day.
Yep.
We just got a hotter than anticipated report on the non-farm payrolls, exceeding estimates by some 100,000 or so. And this kind of has you a little bit concerned, right?
Well, it's kind of going into the world that I'm thinking of, is that the labor markets are way too hot and they're not slowing down. And labor is where you're going to find the wage inflation pressure is what's going to keep inflation up. And so we're in a world, we're talking about soft landing or hard landing, and in my view is no landing. I mentioned this just as we started, before we were recording, about stagflation. It's a little retrograde to say it that way, because I don't really feel like this is quite stagflation. But we're going to have, the economy is too hot and it's charging on, and it's not going to bring down inflation. You have to have wages drop, and to have wages decline, you have to have excess supply in the labor markets. And we're not there. Mm-hmm. Wages and jobs are charging ahead. And so what that means is that I don't think the markets are prepared for what the Fed is going to have to do. And I also feel that the markets are they're looking at the last war. They're looking at what happened in the great financial crisis when banks didn't have a lot of money to lend. And we're in a different world now. And we also have private credit in the shadow banking system that is creating a much different world to have the money transmission, or the high-powered money is being worked through different ways. It's the private credit markets, not banks, that are making a difference in how the economy is moving. And there's very few bad shadows there, though there's some interesting things with the real estate markets, commercial real estate, in particular office and retail, that, are lurking. And that will hit probably regional banks and community banks harder. But, the banking system is in pretty good shape. It's the private credit markets that we're going to have issues with. Anyways, that big ship is moving pretty fast, and we're not slowing it down. So the question then becomes for the economy, how long do we charge ahead before the Fed says, okay, we're going to have to raise rates, which nobody's thinking about, or higher for longer is going to be a long time. So we have this choice with the Fed. Do they start putting on the brakes harder, or we just let it slide, or do we keep, say 3.5%, 4% inflation rate? It's okay. So as a money manager, you have a choice then. You have to say, okay, we have inflation, where do I hide? Or, okay, we might have a much stronger recession, and make money at the same time. So I have some thoughts there. I mean, of course, short-term money is not a bad place to be, especially if you feel like the Fed's really going to raise rates and then we have a complete slowdown. We also have a large part, a bit like the tech bubble. We have a narrow, as you probably are aware of, leadership in the S&P. Yeah. So that can also make some interesting opportunities.
Yeah, that is a bunch of stuff right there. I want to start here with the economy.
Right.
Look, the jobs report, this is just one report, right? We had earlier in the week, we had some soft PMI numbers, especially on the manufacturing front.
Yep.
And we also had a JOLTS report that came in below expectations. I know JOLTS is more dated than non-farms, blah, blah. Nevertheless, those reports, when they came out, kind of gave rise to some concerns about the economy,
Right.
which have now obviously been brushed away. But is there a chance we're overreacting to this one jobs number?
You know, we've had a bunch of data that's kind of saying we're not slowing, right? And in the case right now, bad news is good news, and good news is bad news. So strong labor markets means the Fed's not going to cut. So it's the bad news is, not, right, it's bad for the markets because we want the rates to be cut, and we want we want liquidity. And so we've the 10-year got close to 5% in October of last year ish, and we went way down, and then January we popped right back up again. We were down since the beginning of this month, like almost I think we went from 480 to 430, and we're now popping back up again. And so we've been bouncing around here a lot, and I think the market wants a rate cut, but the economy is not agreeing, and so everybody looks at every little bit of data and saying, oh, it's getting easier. And then we have today, and it's not getting easier. We're bouncing back and forth. It's a bit, right? We don't have a clear trend. So my view is the trend is what it is. We're going full speed ahead.
Okay. And another thing, though, on the Fed, we also had this week, it's been a busy week, the Bank of Canada and the European Central Bank cutting rates. And so that removes a little bit of pressure on the Fed, you would think.
We have a different economy. We've been spending money like drunken sailors. So our fiscal policy is roaring. We have, trillions of dollars, and a lot of that has been allocated and not spent. So when it gets spent, that's going to drive up the cost of goods and services because you're bidding up the price. And then the question is that debt has to be issued, right? So if the Fed is no longer buying up the debt from the Treasury, what happens? Rates will probably go up because we have, more supply than demand. So that again is it becomes a real interesting dilemma now. How do we? I was at just before I got here, we're talking the level of, I believe it's the issuance of Treasury. The debt is at a level that we haven't had since like George W. Bush. In the Gulf War, and he said, "Read my lips." And the level.
Oh, the first George W. Bush.
Yeah.
Or yeah, George H.W. Yeah.
H. Herbert Walker, excuse me. And so we also have, interest rate payments on the federal debt is higher than defense spending. To give you a level.
Yeah, then can't the Fed just cut rates and kind of inflate their way out of that?
Yeah, that might be the way to go, right?
Yeah, as long as people keep buying the treasuries, right? Who cares?
Right. When do we have too much? When do we start crowding out?
Well, yeah, right.
So crowding out is an ancient concept, which you have to go back to the 70s and be old like me.
So stagflation light, it doesn't sound like you're concerned about full-fledged stagflation like we had in the 70s.
No, we have to have a couple policy missteps. And right now, I don't see the Fed making that. The question is, are they happy where we are at 3.5, 4? Or do they want to bring it actually down to 2? And then the question, of course, for me, maybe I haven't thought this through enough, is what is going to be the role of fiscal spending? We have a lot of money that's being spent by the government. So, so then where do you hide? And, so I don't want to get too far down this path because I'm not sure anybody knows, but I think we have to be aware of, like, there's this choice that we have with the Fed. And I think the Fed, they made a mistake. And like I said, I think we're not understanding the regime that we're working under. We're working under the great financial crisis. And this is not the same place.
So deflation is not a risk.
Deflation is not a risk. We'll have deflation. We need inflation to slow, right? So before we get to deflation, you have to have disinflation. So we have to have probably a credit event. You have to have things break. You have to have, somebody go, we did last spring, right? We had 3 banks kind of blow up. Stuff started to break.
Mm-hmm.
But you have to have that to really have a labor event, and we're not having that.
Mm-hmm. And you don't think there can be a gradual slowing in the labor market that kind of eases this?
If we had inflation closer to, let's say, 2%, yeah, I'd say that would work.
Mm.
But we're almost double that.
Mm-hmm.
We're closer to 4 than we are to 2, right? And so I don't see us having a slowing market. Most markets now are anticipating 1 or 2 cuts this year. I don't think that's the case.
It seems like you're pretty confident the Fed will not make a mistake here.
Oh, I think the Fed is going to make a couple mistakes.
Okay.
The question is, which ones do they make?
Right. Well, if history is our guide, then they've always, not always, but the last 30 years or so, have erred on the side of creating inflation.
Yeah, because we're in a disinflationary world. We're in a credit. In the great financial crisis, when the credit markets blew up, we had a shortage of liquidity, and banks, we had a different model then than what we're operating now. The velocity of money completely slowed. People were hoarding money. Everybody was hoarding money. Banks were hoarding money. We weren't making loans. We're making loans now. People are lending, borrowing. We're building new homes. Now we're not having the existing home market is completely slow because nobody can afford to leave the mortgage that they have. But if you're having family creation, new homes are doing pretty decent. And the private credit markets are still going pretty strong. The way we look at credit and banks and money creation, banks are no longer the only place that creates money.
Sick of me yet? Become a premium subscriber and avoid all ads or interruptions. Other benefits as well. Visit contrarian.supercast.tech for more information.
Lending is happening through the private markets, the shadow banking system, and that has money and it's lending, which is different than the great financial crisis where there was no such thing.
Mm-hmm.
There was no shadow banking system. That came up out of the wake of the great financial crisis. And that's what's different. And not a lot of people are thinking about that and what it means in terms of monetary policy.
And what does it mean?
It means that there's a longer lead. So you don't just slow banks. Banks are not necessarily creation. So if you remember, it used to be the high-powered money, right? In economics, the Fed lends money, it goes into the bank lends it out. The person who it lends to deposit it back at the bank, then they lend that out, and there's the reserve ratio, the 1/R that goes out into infinity. It's not just banks that are making those loans now. So that credit market creation, the creation of credit is happening not just in banks. So it's a whole different world of that's different than the great financial crisis. And the velocity of money, the way money spins and works into the system is different. And I think the other thing is quantitative tightening is something we haven't really lived through. We did it through 18 and 19, and in 2019 in the fall, we had overnight rates spike. Did you remember that in October? I think
Vaguely.
It was. Yeah. And they jumped because quantitative tightening all of a sudden created this place where the reserves for banks got out of whack, and they had to find and search for securities, and that's it's a different world now. Quantitative tightening, that's the only experience we've had with QT was that period. We're back into this, and we're not sure where it goes, and the Fed's also trying to be careful because they don't understand it.
Mm-hmm.
If we did QT for for the last we've had 2, 5, 6, 7 other episodes of quantitative tightening, we'd get it. But we don't. We don't know what it means for the Fed to do this.
I mean, we had it in the pre-08 period, right? The Bernanke Fed.
Nope. The Bernanke Fed did the opposite. The quantitative easing. They were the first. Helicopter Ben. Right?
Oh, right. So there was nothing they weren't doing anything. They were just doing interest rates. They weren't doing anything on the Q side.
Well, people would do, not to the extent that we did. I mean, people realized that we could use well, yes, buying and selling securities changes interest rates, right? They figured that out in the Great Depression. And then, we had Paul Volcker was he's took us away from targeting interest rates, and he's targeted the rate of increase in money supply. And that's what Volcker did. So I'm going to increase the money supply at this rate. Interest rates go where you want. And he killed inflation because he didn't care. And then rates spiked, hiked, went to 14%, right? Treasuries. And so that killed inflation because he said, I don't care where the rates go. I'm going to keep the money supply growing at this rate. And he totally rearranged the way we thought about money supply. We have a different regime now, and I'm not sure what to think about this with quantitative tightening. I mean, it's a bit of an experiment.
I mean, ultimately, these shadow banks, do they even lend from the Fed, borrow from the Fed?
Nope, they don't, right? So that's what's part. They get money from pension plans, from insurance companies, and that excess liquidity takes a while to dry up, in my thinking. Right. So the banks, so you have the dealer banks, they put money into the supply, it kind of flows through, and then you have to tighten the money supply. And part of that is, we have short-term rates at 5%. So people, instead of looking for, when you have a 1%, 10-year, that's a whole different world where, you have 5% overnight money.
Yeah.
Why take any duration risk?
Well, that is the question. And then, I mean, the shadow banks have the same dilemma.
To some extent.
Yeah, but why would they make risky loans if they can just park it at the Fed and get 5% and change? I mean, when's that becomes an option?
Well, because let's think about this. If you have first lien loans that are variable rate, right? You can make a loan to a medical office or a medical real estate REIT, and you have a variable rate loan, and you have first lien. So if this business goes belly up, you get to own it and sell it. So it's pretty much money good, and you're getting 8% on that. So yes, you may not be able to. The issue for private credit is what they borrow to make the leveraged loan, right? So they make a good loan, but you have to borrow, and as long as you can make the interest payments on what you've borrowed, you're good.
And who's lending to them? BDCs and
BDCs, yeah. Well, BDCs and banks, and BDCs are the people who make. I would say, so the right BDC can be. It's doing what banks used to do. Banks used to make those first lien loans. They've almost been prohibited from that by the new regulations that came out of the great financial crisis. So out of this grew the shadow banking system. And that credit creation it's a different world. I don't know. First of all, I'm not an expert in that, but I just know that this is where you have to think about where the money is flowing. And that's just my view of the economy. I'm kind of think it's a different world, and we have different rates of velocity and different demands for money. And that mechanism, because the private credit is getting their money from banks, right? So they're a bigger entity, they do. But that slowing of credit takes time until we have a blow up.
I was going to say, but credit dries up pretty quickly, whether it's private credit or government credit. Actually, I would argue that private credit would dry up quicker. So if there is an event, wouldn't those spigots shut off automatic or overnight?
Yeah, if there's an event, but it's high rates on this. The rates that we are now is not enough slowing, but not enough. So
and you don't think you're not concerned about the risk of that cause?
I think it's a huge risk.
Yeah.
But the question is, see, the Fed is trying to land the economy. They're trying not to have an event. And I think the economy has so much momentum. The only way they can slow us is to have a credit event. Because typically that's what you need to have an economy slow. Right? And so we have to have a credit event that causes jobs to be lost. You lose jobs, wage inflation, wage pressures go away because you're thankful to have a job. Right? And until we have something that slows down job creation, which is usually a credit event, especially when we're at 4%, we're historically low, you have to have something that really slows down the demand, because the other side of this is that the consumer has had, inflation, right? So the price that you pay for food today for most people is higher than it was in 2019, and it's a bigger part of, and your wages have not kept up with food inflation, right? We've heard this.
Yeah.
And that's people on saying, well, why is the public not understanding the economy is good? Well, it's because the price of food and oil and gas are higher today than it was in 19, and takes a bigger chunk of your budget. And yes, my wages have gone up, but not as much as those items in aggregate.
Yeah. And yet the consumer keeps spending, and discretionary spending is, fine, and retail sales and all these things.
But nobody feels good. My sentiment is horrible.
Yeah.
Until we really have sentiment may be bad because I think people are nervous, but until you have but you're still getting good wages, right? And you're still demanding wage increases.
Mm-hmm.
And still we have, so the economy is strong enough that you can demand higher wages, right? But it's not weak enough where you can say, I'm thankful to have a job. So I'm not, so until you have people not demanding higher wages and just thankful to have a job, wage pressures are going to be strong enough. Wage push inflation.
And you say the only way for us to get there is to have a credit event.
Just possible that we can have a slowing, but the economy has so much momentum. I mean, we just added 270,000 jobs. That was the report today. That's a strong market.
Is it though? Because I mean, how many people are in the labor force now? I mean, don't you need like more than that to? I mean, you go back even like to the start of the year or last year, like these non-farms were like 500,000.
Yeah. So, but so if you want to have, so we have roughly population growth of 100,000. So if you want to have 100,000 jobs, kind of matches the rate of population growth. So when you're twice the rate of population growth, people adding
You're
jobs.
In good shape.
Yeah.
Okay. Oh, wow. This is all very interesting. And well, last question before we move on to what it means for investing, just about the Fed.
Yeah.
It sounds like the proper thing to do might be, I mean, can Powell pull a Greenspan? And I mean Greenspan of August or September.
Yep.
No, of the 2000 Greenspan, when he, remember there was a one day where he hiked up the interest rates by 50 when he was expected to do 25. And that was what put the final nail in the coffin of the .com. Remember that? In like summer of 2000, late summer 2000. So could Powell do something similar here and be like, okay, I'm hiking? And he probably wouldn't even need to do 50. He'd probably just do 25.
Any hike would be spook the markets horribly.
No question.
Yeah.
But that would kill. Would that do the trick that we need?
It would blow up markets. I'm not necessarily sure it would slow the economy enough, but maybe. I mean, I think we probably need, with 3 or 4% inflation and with the 10-year at what, 3.8, you're not getting a lot of value for your money for going out 10 years. Now, short-term money, yeah, it's hard to borrow. But I'm not necessarily sure that's enough. I'm not sure what is right now, right? Neither is the Fed.
Yeah. But you don't think there's any chance the Fed does another hike?
Not this year. But you look out next year, and if we still have momentum, how long do they let that go? I mean, is it enough? And then if we, because 3.5%, 4%, if we accept that, then we'll stay where we're at. I think this is kind of where we're at. We're almost at a neutral rate. We're not at a restrictive rate. And so that's a different world. And so if the Fed is okay with accepting 3.5%, 4% as a neutral rate, both for, interest rates and the 10-year. And now, I mean, yes, it's 5% overnight money. It's hard. But, is that going to be enough to really slow this much momentum? That's the question.
Yeah.
Right?
All right, cool. Leo Schmidt, I want to come back and ask you about what this means for investors' portfolios, where to put cash and things like that. But I want to first take a quick break. If you are a premium subscriber, you will not get the break. Don't touch the dial. We'll be right back. In fact, we already are. And to become a premium subscriber, visit the website contrarian.substack.com and sign up.
We hope you're enjoying this episode of the Contrarian Investor Podcast, where we give voice to those who challenge a prevailing narrative in global financial markets. Consider becoming a premium subscriber. For $9 a month or less, premium subscribers receive a number of benefits. Podcasts are posted immediately after they're recorded. Transcripts are made available within 24 hours. Premium subscribers get direct access to the host, and of course, there are no ads or interruptions. Visit contrarian.supercast.tech for more information.
By the way, you don't need the .tech suffix to get to that website. .com will do the trick. And we also have a Substack where you can sign up for the same prices, same benefits, same details. contrarianpod.substack.com. So if you already have a Substack account and use it, or have the app and use that, that's probably the best way to go. So contrarian.supercast.com or contrarianpod.substack.com. Whole bunch of benefits, including, of course, getting this episode up to a week early without ads or annoying announcements. And you also get the daily Contrarian briefing and podcast that is released every market day morning at 7 a.m. This is a contrarian take on the events of the day ahead and what is likely to move markets, such as economic data releases, earnings, and other things. It is really good, and that is completely unbiased, of course. So check that out, contrarianpod.substack.com or contrarian.supercast.tech. Now on with the show. Leo Schmidt, River Eddy Capital. By the way, what's in the behind the name River Eddy Capital?
So I'm on the Delaware River, my country house, and eddies are things that are places where the water slows down, and so behind a rock in a fast-moving water, there's a quiet place behind the rock, even though the water is moving fast, and the water swirls in behind it and creates these pools going against the flow of the river. And so in thermodynamics, those swirls are called eddies. And in rivers, they're called eddies, and I'm on a river. So eddies also where the fish are. So it's a good metaphor for investing, is you want to look for where the fish are.
Yes, you do. And perfect lead in to our next topic, which is investing. What does an investor do now?
So I have a barbell strategy, and I'm being very careful. So I have a bunch of derivative AI plays that have exploded, gone through the roof. And so the question is, do you let your horses run, or do you start easing out? So I'm easing out slowly.
Hold on just a second.
Yeah.
Derivative AI plays, what's that? How does that work?
So there's lots of places that are going to benefit from AI, right? And so I am, I've more by accident have been buying bullets and, into the war, And so there are things like that you have server farms. You have people who have to have these giant servers. So people who build the servers and the equipment that connects them all, that becomes really interesting because those server farms are going to explode with AI.
Okay.
And so you have lots of people who build the boxes and the racks and the connectors and, all that stuff has exploded. So that would be a derivative AI play.
Oh, I see. Okay.
Right,
I see. So you're basically talking, okay, so like AI proxies type of thing.
Yeah, but they're downstream. Right? Not the chip. You're not the Nvidia chip.
I got it.
But you have these giant server farms that have to, store the data. Right, that data gets stored in giant farms, and you can also consider maybe REITs for But I owned these electronic EMS, they're called electronic manufacturing service providers. So it would be Celestica, Sanmina, Flextronics, and Jabil, my four favorites. CLS, FLEX, SANM, and Jabil, JBL.
Okay, interesting. I have a list of what I call undiscovered AI chip stocks.
Yeah.
And they're mostly suppliers to AI. And there's 7 names, but not any of the 4 that you mentioned. But that's another topic for another day.
Yeah, but these well, they're kind of already like Celestica. I bought back in 2019 around $5 or $6, and it's trading over 45 today.
Mm-hmm.
Actually, I think it hit 60, so I don't know. I'm probably closer to 55. My bad. I'm not remembering. But I sold this a little bit. So to be honest, I'm scaling out a little. But I was
going to say, yeah.
But when you have that kind of, but like I bought. Full disclosure, I bought Nvidia $12.07 average cost, and I sold it at 120. So if I waited to today, I would have had not just a 10 bagger, but a 100 bagger. But
yeah, but then you wouldn't have to do podcasts, and I wouldn't have you on. So
right, and I wouldn't be a contrarian because I sold too early.
Yeah. Okay, so you've had these AI derivative names.
Yeah.
See, when you said derivatives, I was thinking like options. But
no,
okay.
The derivatives, well, for me, it's business derivatives.
Understood. So you have these 4 CLS, Flex, Sanmina, and Jabil.
Sanmina, yeah. And
but you're scaling back as they run up.
Right.
So what? Okay.
So we've had the AI splurge, and rightfully so. AI is going to be a very big idea, but I don't think the business case has been well scaled out. I think everybody's spending money because they feel they have to. Of course, when you have Nvidia growing as big as it is, growing 300%, year over year, quarter after quarter, it's hard to fathom. But it's also a capital equipment company, and they, at some point, those chips, when do we have enough? I don't know, but I think the business case has not yet been solidly scoped out. So and then there's lots of places that have been left for dead, and that's where I like to look. So I love the spin outs of pharmaceutical companies. And so these names are great places to hide with a potential either inflation or a recession. They have pricing power, and they also have steady demand. So like Procter and Gamble, these guys are going to be, you need like soap, you're going to need your Tylenol, you're going to need your fungus cream. All that is like a consumer product demand that is very steady and has the ability to pass through inflationary costs. They've been spun out of large pharma. There's 4 names that I own. And these guys have been loaded up with a lot of debt by the pharmaceutical companies that spun them out, and they've also new names, so they're not in the public's name. And because of their level of debt, people get fund managers that say we only buy high quality names that can't buy them because their debt's rated BBB, but they generate a ton of cash, and the cash is very steady, even in a recession, because you're buying Tylenol. The average investor is just not aware of them. So they often trade at single-digit PEs, yet they have free cash flow yields that are 8, 9, sometimes 10%, which is through the roof. And they are paying down their debt. They pay nice dividends above 4%, and as they pay down their debt, they're going to raise their dividends. And so this is a long run dividend play that's relatively safe, that's overlooked. And you have, if you're Procter & Gamble, you're trading at 24 times. These are single digit PEs. And in essence, it's a similar company.
Okay. So what are they?
So there's Haleon, HLN, which was spun out of GlaxoSmithKline. There's Kenvue, which was spun out of Johnson & Johnson, and Kenvue does Noxzema. They do the Tylenol. There is Organon, which was spun out of Merck. I should give you tickers for these. So Kenvue is KVUE. Haleon is HLN. Organon is OGN, and Viatris, which was spun out of Pfizer, but it was a combination of Mylan and Pfizer's Upjohn Pharmaceuticals, and that was spun out, and that's Viatris is VTRS.
Okay. And so those four. Now, what are they all? So they all do kind of staples type of stuff.
Yep,
So,
yep.
so
Let me give you Haleon, which is probably the most expensive. Haleon, I'd love to get a second bite of that apple, but I kind of waited and it ran away, and I think I might get a second chance. But Haleon has 19 brands that are over 100 million each. And so that's a real steady Eddie ship. You know, $100 million brands are like hard to create. And this is the kind of stuff like it's for hay fever, you know, so it's like these are brands that were, you know, over-the-counter drugs, you know, they were prescription drugs and now they're over-the-counter, right? And so all this brand equity is fantastic. You're not going to, you know, and you're not going to have, you know, generics run in and take a share away because you have, you know, this is a branded, it's like Band-Aids for, you know, Kenvue and Tylenol. You're not going to get, Band-Aid has a fantastic brand. You're not going to get rid of that. Yes, little plastic and gauze could be easily replicated, but we don't have the trust as a consumer to buy something new. J&J has it. And so these all have these very strong brands that are medical or health and beauty. And, you know, they have yes, they will be affected by a recession, but they will still, you know, keep moving forward in a pretty good way. And you're paying not much. I mean, literally single-digit PEs. So, and free cash flow, that is, you know, you're paying way above 7 for most of these. And so that becomes that to me is a cash flow for that kind of quality of steady cash flow. Now, the downside is they have a lot of debt. So, but they can pay the debt, they can service the debt. And so that's the real question. And so, and they also, they've had their issues as public companies. So they have, you know, they have to reorganize their supply chains. They're going to, you know, all that disruption has created difficulty in predicting their earnings. And then they buy, you know, they're going to buy this or sell that. So these have all been spent out in the last 2 years. So there's still disruption in their business, but the essence of the business is still the same. And the cash flows are very steady. Yes, you might miss earnings estimates here and there, but they'll get that down as they organize their supply chains and, you know, figure out. And I mean, they used to be, we call them orphan companies because they were the cash flow pigs for the pharmaceuticals, that they had to supply all the growth money, the growth capital for the sexy business. This is an unsexy business. Now they have their own cash flow and they can use it as they see fit. And they're beginning to reorganize their brands, the way they market, you know, so the marketing, the distribution networks all get slightly tweaked, and you know there's disruptions, and that will get sorted out. And you know these are competent managers that have been running these businesses before they were public.
Yeah, interesting. And I guess those missed earnings and other things would create entry points if you're so obliged.
Yep. You know, and then you know they also say we're going to buy this or not buy that. You know, they have a variety of stuff that's all basically saying we're figuring out. Like, you know, we're going to I think it was Organon was going to divest something, and then they said no, we're not going to divest, and you know everybody's jumping around. But understand basically what you're getting is a really steady Eddie business that has very low risk with a low PE, and you know, doesn't really matter. I mean, all this is noise in the long run. When you have a 4 or 5% dividend, you can sit and wait with that, and if it grows 3-4%, at least you're keeping up with inflation on a dividend, and it's acting like a bond. This is a bond proxy.
Yeah.
Another place I would like to touch base with, if you got a room from another name.
Yeah, absolutely.
Sick of me yet? Become a premium subscriber and avoid all ads or interruptions. Other benefits as well. Visit contrarian.supercast.tech for more information.
The dollar stores, and in particular Dollar Tree right now, DLTR, Dollar Tree bought Family Dollar back in 15 or 16, and it was a really bad match. There were two separate businesses, and I've owned both of those as well as Dollar General. And let me just take a step back and say the dollar stores are really contrary businesses in a recession, except as you go into a recession, which is kind of where we are at now, they perform poorly. So they're getting beaten up. And why they perform great in a recession is the low-end consumer doesn't buy, right now they go to Walmart and they buy lots of rolls of toilet paper, big, 20 at a time. And but when you lose your job, you can't afford to buy 20 rolls of toilet paper because you don't have the excess cash. You can't hold it in inventory. So when you run out of toilet paper, you got to run to the local store to buy your 1 or 2 rolls, which is Family Dollar, and it's cheap and it's convenient. And so that means it's a contrary. So when you're in a recession, people don't hold these giant inventories, but you run out of something, toothpaste, toilet paper, you got to run to the store to get it. And they do have great comps. And it's been like that since the 1980s. And they are different than Amazon because you can't, yes, you can get some toilet paper from Amazon overnight, but you need your toilet paper today. Overnight doesn't do it. The Sears and Roebuck catalog, you can't rip a sheet out. And it's that being graphic here, but that need is what you can't have a delivery service fix that. Maybe you can in cities, but not in rural areas where these guys are located.
Yeah.
So Family Dollar was bought by Dollar Tree just this week. Dollar Tree made a strategic announcement. They're looking at options for Family Dollar, which I suspect means it's up for sale or they're going to spin it out. Dollar Tree has had fantastic growth because what they have done, it used to be everything was $1. So now they said, well, we can't afford that anymore. So it's now $1.25. And then they started to do multi-pricing items of discretionary things. And they've added, like Family Dollar has, consumables. And so that consumable business and are going upscale with some, nice items has meant that a higher end consumer has now started to go into Dollar Tree stores. And so they're expanding their base and they're expanding this consumable base, and they've had fantastic comps. And they were running this Family Dollar business, which they bought in 2015, which they had no idea how to run because Family Dollar has multiple pricing. And so the whole ability to run these two businesses, there was not a lot of synergies, not warehouse. They had 2 separate distribution systems you had different accounting. There was no synergies. So, now they're realizing we got to split. We have a new guy running the Dollar Tree who came out of Dollar General. He made Dollar General run like a top. And he's going to do the same thing for both of these and probably split them apart, which is what they should be. And so you're going to have a business that has recession resistance, and then you have a catalyst how this gets split apart.
And you like DLTR better than DG, Dollar General?
Dollar General it's beginning to, so these stores typically as you come into a recession, their consumer goes more to Walmart than to these guys. And so as you have better times, their comps kind of just slow down, which is what's happening. They're having positive comps, but they're slowing. But I'm hoping Dollar General has a real misstep, and then I'll pile in.
Oh, it's been down. It's down a bunch.
Yeah, but it's down 50%. Yeah, but I get greedy, so I as we come into this kind of a world where we have rates where maybe I get a bite a little lower, so I'm waiting. But yeah, Dollar Generals are great. It's down a bunch, and they have fantastic runway in terms of new stores, as does Dollar Tree and Family Dollar. There's just new real estate that they can buy and go into, and then there's contiguous expansion in Mexico and Canada.
Oh, okay. I wasn't aware they were doing that. Yeah.
Well, it's out there.
Yeah. No, full disclosure, I hold Dollar General, and bought it on the way down, and it's underwater, but not that bad.
So I think you'll be fine. I don't know where you bought it. I mean, if you bought it when it was the price.
Well, I bought a slugs of it. Some were great and some were not great.
I think you're going to be fine.
Hopefully. Yeah.
If you want new money to put in Dollar Tree, take a look at that. Same idea.
I mean, I would imagine that would have bounced after that announcement of the divestiture.
It did, but they announced it with bad earnings. So people look at this as being in the pre-market, it bounced up 6%, and then when it finally opened, it dropped like 3 or 4 because everybody said, "Oh, you missed your comps, so you're just hiding this breakup with comp." So people took a look at that announcement as being a way to placate the market, and maybe it was, but you know, and
yeah, it's an interesting business, these dollar stores. I mean, if you drive around, as I did recently into like rural America, you know, any small town you go in America, if it doesn't have anything else, it has like a Family Dollar or something, one of those stores.
Dollar General, yep.
And maybe there's a McDonald's or something, and you know, a church and all these, a couple other things, but that's it, you know, and that's the one recourse. It's the one place, like you said, for people to go if they need something right away.
Right, and you cannot be Amazoned out. You can't. I mean, in the city you have DoorDash and all these other places that will run your toilet paper if you're too lazy to get it. But you know, in the rural America, you can't.
Yeah. And how much of their business is rural versus urban? Probably.
Well, so Dollar Tree has some urban stores and some. But Family Dollar is mostly a rural, and Dollar is also you know, kind of I'm not sure what the exact split is, but there is, you know, Dollar Tree, because of this treasure hunt aspect to it, does okay in a urban environment because people come in for a deal, like you do for Costco, you know, the treasure hunt, TJ Maxx, the treasure hunt.
Yeah.
And those treasure hunts are relatively, you know, that's a spot in retail where you can be relatively secure against, you know, an internet business. Yeah.
Very cool. Leo Schmidt, thank you so much for joining the Contrarian Investor Podcast today. We're almost out of time. Maybe in closing, you tell our listeners where they can find out more about you, more about your firm, and I will include that in the show notes as well.
You know, and Nathaniel, I have a family office, and it's a very selective clientele, so I'm not looking for clients.
Okay.
So that's, for better or for worse, you can take my word, meaning I don't care if you come here or not. The one other thing we want to touch on is, because in the first time I was on, I think I was very bullish on oil, and then
let's talk about oil.
Oil, Ukraine had just been invaded, and oil went to 120, and right now we're at 60 and 70. And I just want to say, I think oil as a place where I think it's a great spot to invest, but I don't think you're going to have high upside or high downside. But I think we should take a look at pipelines. Because I'm not sure where the price of gas is going to go, but we know we got to move it.
Right. Yeah. You know, Kinder Morgan and Williams, right? Those are the two main public plays in that sector.
Is another name.
Right.
I like Equitrans.
Yeah.
There's the Mountain Valley Pipeline, which just got approved. Well, that's a long story. It crosses the Appalachian Trail, and there's a lot of legal issues with that.
Yeah.
Anyway,
and those aren't just oil proxies. Those
they are, but because they're pipelines, the price of oil doesn't make a difference, or the price of natural gas, because they are paid. They have take-or-pay contracts, and then they you know, whether it moves, whether gas is $2.50 or $5 an MCF, they get paid to move it.
Yeah. We've had people come on and talk about those previously. I thought, and there too, full disclosure, I'm long KMI.
Nice. So you got it.
I did, and it's started to do a lot better than it has. And talk about a bond play, and that's 6% yield now, I think, on this.
Yeah. So. And think about this, you know, in terms of yield. I mean, dividends are a great way to hedge inflation. Right? Because dividends should be growing at a nominal rate. So as you have inflation, it typically gets passed through, goes up in your earnings, and then that gets passed through to your dividends. And that will grow with inflation. Now, not exact, but it's a pretty decent hedge. And if you're looking for income, it's a great place. Much better than, you know, looking for any kind of duration plays. I mean, you have short-term money that may go down or may go up, but dividends will be growing. And so I think anybody who wants to have income, you got to look at dividend.
Cool. Very nice. All right. Well, that's a great way to wrap up here on this Jobs Day, June 7th, 2024. Thank you, Leo, again. Thank you. So you're not on social media or anything? You don't put your thoughts out there at all? Okay. I guess you don't need to.
What I do is CFA Society.
That's right. Yeah, you do. Okay. We'll talk about that. Yeah. And the New York CFA Society especially. Yep. Cool. Awesome. Wonderful. Well, thank you all for listening. Thank you again to Leo. We'll see you again next time. Speak then. Bye.
Thank you for listening to the Contrarian Investor Podcast. We hope you enjoyed this episode. To subscribe to this podcast, simply open your favorite podcast software and search for Contrarian Investor. Follow us on social media by searching for Contrarian Investor on Twitter and Instagram. Send us your thoughts on feedback@contrarianpod.com. We look forward to speaking to you again next time.